our concluding speaker is Ben Johnson. He's Director of Global Exchange Traded Fund Research at Morningstar. He is a, let's see, get the right page here. He's editor of the Morningstar ETFInvestor, a monthly newsletter. Previously, he was director of ETF research for Europe and Asia. He has also served as senior equity analyst covering agriculture and the chemical industry. Before joining Morningstar in 2006, Johnson worked as a financial advisor for Morgan Stanley. He holds a bachelor's degree in economics from the University of Minnesota. In 2005, fund directors and Fund Action named him among the 2015 Rising Stars of Mutual Funds. So Ben, we're glad to have you here. And again, the topic is the ins and outs of investing with mutual funds. So you have the podium, Ben.
Well, thanks so much for the invitation, first and foremost, Lynn and everyone else within the chapter, and for the kind introduction. Given that it's a rainy Saturday in the springtime here in Chicago, I can't rule out that I'll be making introductions to my daughters and my dog at some point during the presentation, but we shall see. Any guest surprises will be pleasant ones for everyone involved. So as Lynn mentioned, I'm going to be talking about the ins and outs of investing with ETFs today, talking through it a very high level to begin with. What is an ETF? I think there's a lot of misconceptions, in some cases misinformation that persists out there in the marketplace today, despite the fact that ETFs have now been around for decades and have really, I think in the past 10 years or so, been mainstreamed and found a place in many investors' portfolios. Nonetheless, some of these misconceptions, misunderstandings about what ETFs are in their essence persist to this day. And part of defining ETFs, I think, is important, is defining what they are not. So I'll touch on that briefly before transitioning into a discussion of why investors might choose to use ETFs over other investment wrappers within their portfolios. As we come down the home stretch, I'll finish by talking about a few of our favorite ETFs that are Morningstar medalists that we have a positive view on. And at the end, I'll reserve more than enough time for questions from you all. And I would stress that this is our Saturday, so let's make the most of it. I'm here to hear what's on your mind as much as I'm here to tell you my thoughts about ETFs, their benefits, their drawbacks. So please, at any point in time, raise your hand, shoot a question through the chat function. I'd be happy to answer any and all questions that you have, so that you can get as much value out of this session as is possible. So let's jump right in and talk about definitionally what is an ETF. And I'm going to start first by framing ETFs sort of in the long history of managed investment funds and drawing parallels really between technology. And what ETFs are, I would argue, in their essence, is a 21st century investing technology. And like any good technology, what you see is that ETFs have improved on prior versions of that same basic technology, on that same basic functionality, which in the case of managed investment funds is really pooling investors' assets in such a way that investors can, at smaller investment minimums, access broadly diversified investment portfolios in as cost-efficient a way as possible. Now, these means have been available, of course, for hundreds of years. The oldest mutual fund dates back to I believe, mid-1700s, in Amsterdam. And what we've seen over the years is that technology, that packaging, has advanced no different than the telephone, than the automobile, than the way that we're interacting with each other at this very moment. So ETFs, I would argue, are really simultaneously a product of and a poster child for the information age. When you think about, just at its most basic level, the amount of computing power that is needed to support the ETF ecosystem, it simply didn't exist a few decades ago. So when I say the ETF ecosystem, what I mean is not just ETFs themselves, but the fact that ETFs are traded on stock exchanges all day, every day, no different than an individual security like Apple or Tesla or Procter and Gamble. These ETFs are tracked by indexes that are being calculated in real time. So there are index providers that are out there that are taking real-time information about the value of all the different stocks that are invested in that particular index that ETF is out to track, and they're calculating them each and every millisecond during the course of the trading day. There are market makers that are out there that are quoting no different than they would for stocks, bid and offer prices for ETF shares, again, in real time. So you think about just all of the zeros and ones that underpin the ETF ecosystem, just how rapidly they're moving around the world in any given moment. This is really something that has been enabled by advances in technology is we know it more generally outside of the sphere of investing, and information technology in particular. The other thing I would argue is that the success of ETFs, which have grown now to hold trillions of dollars of investors' assets all around the world, is in many ways reflective of broader global trends towards greater transparency, lower costs, and just in general disintermediation. And what you see with the ETF wrapper is that many of the benefits of the technology fall into those three buckets. They offer a more transparent means of accessing an investment portfolio, in many cases disclosing the entirety of their portfolios each and every day, disclosing the costs of investing in those portfolios in the form of bid and offer spreads quoted on the secondary market. Their costs tend to be lower, both in terms of the fees and other frictional costs that I'll get into in more detail later. And the level of disintermediation. When you think about ETFs, by virtue of trading on an exchange, no different than any other individually listed equity, are more accessible to a larger number of investors than mutual funds ever were, or frankly, probably ever will be. When ETFs were first introduced, it was kind of a coup in many cases. I remember, as Lynn described earlier in reading my bio, working as an advisor at Morgan Stanley. And Morgan Stanley, because Vanguard, as an example, would not pay Morgan Stanley for eye-level shelf space within that particular distribution platform, wouldn't pay for distribution, wouldn't pay to play, Vanguard funds were effectively off limits for Morgan Stanley advisors at that point in time. Now that all changed when Vanguard introduced an ETF share class of its mutual funds, which all of a sudden a Morgan Stanley advisor could trade no differently than they could trade shares of JP Morgan stock on behalf of their clients. So that disintermediation, that end run around all of the traditional barriers of sort of access of entry to traditional distribution platforms was really a coup for ETFs, and one that many of those intermediaries are still struggling with to this very day. And they're struggling with it because their palms are no longer being greased, and all of the grease that was otherwise going onto their palms is now actually accruing back to the benefit of the end investor that isn't paying any line item fee in those funds expense ratios for that distribution, as they might be in the case of a mutual fund. So moving on from talking about ETFs as a technology to, I think, understanding ETFs definitionally in terms of how money comes into and leaves from the fund. So I think this is a very important, very foundational concept that is critical for investors to understand, because it really is the basis of all of the advantages of the ETF wrapper relative to traditional mutual funds and in other investment wrappers. So when I say how money comes in and goes out from the fund, I think many of you are probably very familiar with this process in the case of a traditional open-ended mutual fund, which I would describe as a cash in and cash out proposition. So when I, as an investor, want to invest more cash into XYZ mutual fund, I hand that cash over to the fund company. The fund company, in turn, tells the portfolio manager that there's new cash coming into the fund that they have to invest in that portfolio. The portfolio manager turns around and puts that cash to work in the capital markets, buying new securities in the portfolio. So either adding to existing positions, initiating new ones, preserving some of that cash, maybe it's offsetting to some extent redemptions, or maybe they just don't see opportunities in the markets at the moment and would rather just sit on that cash and hold it as a call option of sorts when they can use it at such a time as opportunities present themselves in the markets. Now that process works in reverse when I want my money back. So say if I've fallen out of love with the fund or the manager, or I simply have used that fund successfully, the manager has done good by me by growing my money over time, and I'm now at such a time where I've saved, I've invested, and now I need to spend against whatever my goal might be. I call the fund company up again. The fund company says, yes, we'll get you your money back. And the manager has to go back to the market, and if they don't have cash on hand, liquidate certain positions in that portfolio to meet my redemption request. Now, what happens in these transactions, irrespective of which direction they're going in, is that there's an amount of friction that is being absorbed within that portfolio. So there are costs to buying and selling the individual securities, be those commissions or bid offer spreads or market impact when the manager is actually going to buy or sell those securities. There are also other costs that result, in particular, when you see selling activity. In many cases, across many funds in recent years, what we've seen is massive redemptions, particularly among actively managed open-ended equity mutual funds. And what those redemptions have caused, especially in the context of what has been a generally benign market environment where markets have been trending upwards and to the right, is negative externalities for loyal shareholders, most notably manifest in the form of regular and sometimes sizable taxable capital gains distributions. So this most notable friction that exists in these transactions, this cash out, cash in proposition that is an open-ended mutual fund, is a negative externality in the form of taxable capital gains distributions, which are just one, I should say, the most notable of many frictions involved in this cash in, cash out proposition. Now, where ETFs differentiate themselves from open-ended mutual funds is that when most of us go to buy or sell ETF shares, what we're engaging in is a transaction with another investor on the stock exchange or a market maker on the stock exchange that wants to take the opposite side of our trade. So if I want to sell shares in ABC ETF, in all likelihood, there's going to be a buyer on the other side of that transaction that wants to initiate a long position and is happy to take those shares off my hands. So the bulk of the activity that we see in the ETF market in terms of trading, in terms of buying and selling, is taking place on a stock exchange. It's taking place in what is called the secondary market for those ETF shares. Now, when supply and demand for ETF shares in the secondary market becomes imbalanced, so investors on the whole are either looking to sell those ETF shares, or there aren't enough shares around to satisfy the demand for them as ETF investors or investors are buying, what you see is that the secondary market will see disconnects, premiums or discounts between the price of the ETF shares and the value of the underlying portfolio. What that disconnect does is it sends a signal to market makers to step in and correct that imbalance between supply and demand. So either to create new shares when there aren't enough on the secondary market to meet demand, or destroy the ones that are already out there when there are too many, when investors en masse are selling. Now, what happens in that case is that the market maker, the authorized participant, which is really just a special breed of market maker, will either, in the case of making new ETF shares, go out and get the basket of the underlying stocks or bonds that represent that ETF's portfolio and then hand them over to the ETF sponsor in exchange for new shares, which will meet the market's demand for new ones. That works in reverse when there are too many shares out there. So the authorized participant will go out and buy the ETF shares from those investors that are selling. They'll deliver them to the asset manager in return for the underlying securities, and those shares will be quote unquote destroyed. They'll no longer exist. Supply will shrink down to a level to meet demand. Now, these mechanics are really difficult to wrap your mind around, and I will admit that it took me probably about 6,000 or 7,000 tries before I finally internalized what this really meant. And I think the easiest way to understand it is really thinking about it in contrast to the cash in, cash out proposition that is an open-ended mutual fund, and thinking about the benefits that accrue to investors by virtue of how money and securities move into and move out of an ETF. So the best example I've thought of to date is the Pompidou Museum in Paris. I don't know if anyone here has ever had the fortune to visit the Pompidou in person, but the architect of the Pompidou did something very novel in the world of architecture. They took all of the guts of the building and they put them on the outside. So when you take all of the guts, all of the HVAC, all of the plumbing, even there's some major staircases that are attached to the outside of this building, what you leave inside is a blank slate, a clean space, a frictionless environment, a bunch of white walls on which to hang masterworks. One of my favorites by Miro is actually featured very prominently in this museum. And this, I would argue, is the equivalent of what ETFs do. So all of those frictions, all of that plumbing, all of those negative externalities that create issues for investors in open-ended mutual funds are turned inside out in the case of ETFs, so that the coming and going of shareholders around you and all of the costs that they create as they come and as they leave are actually absorbed by them as they're buying and selling ETF shares on the secondary market, trading them on the exchange, and have no negative impact on loyal long-term shareholders. And the most noteworthy of these costs that gets turned inside out, that gets externalized in the case of ETFs, are those tax costs, those taxable capital gains distributions, which in the case of ETFs, because they are not cash in and cash out, but stocks and bonds in, securities in, and stocks and bonds out, they're transferred into the portfolio in kind and out of the portfolio in kind. What results is, because there's no actual transaction there, there's no taxable event. So when ETFs are faced with massive redemptions, they simply push out a cross-section of all of the stocks or all of the bonds that are in the portfolio, and they don't unlock any gains that they then have to distribute to faithful shareholders. So this is a real meaningful and material advantage to the ETF wrapper versus the mutual fund wrapper that has everything to do with how money moves into and leaves from the portfolio. So I think it's also important to understand kind of more granularly how ETFs stack up against traditional open-ended mutual funds. As I mentioned at the onset, really what we see in ETFs is just an evolution in the technology that is a managed investment fund that allows investors to pool their assets to invest them more efficiently at a lower cost. So no surprise here that both ETFs and funds tend to be broadly diversified. They tend to hold a wide swath of securities. They can cover a number of different asset classes. You can have both index tracking and actively managed ETFs and mutual funds. So the term active ETF is not an oxymoron. Although 98% of the trillions of dollars that are invested in ETFs today are invested in ETFs that track an index, there is a growing number and a growing amount of investors' assets in actively managed ETFs. And indeed, just in recent years, we've seen more and more firms that are best known for their active strategies, specifically within the equity space, begin to enter the ETF arena. Notably last year, Fidelity and T. Rowe Price launched ETF replicants, if you will, of some of their most successful actively managed mutual funds. Frequent portfolio disclosure is actually more so a feature of ETFs than mutual funds. Now, I would argue that most investors probably aren't going to care what the contents of their funds portfolios are on a day in, day out basis. But what this does, this level of transparency, which in the case of most ETFs is daily, is it facilitates those transactions that I described earlier. It gives the market makers, which are an all-important player in the ETF ecosystem, the information that they need to quote tight bid-ask spreads in ETF portfolios to keep those ETFs prices as close to their underlying net asset values as is possible. Intraday trading is a feature of ETFs and not a feature of open-ended mutual funds, and one really, frankly, that can cut both ways. Many would argue that it creates a greater temptation to trade. The best work that I've seen on that particular topic shows that that's actually not the case. Some, I think, benefit from that feature. Some, frankly, might not. It might be better served by an open-ended mutual fund that tracks a comparable index, for example. Daily creation and redemption is a feature of both. So you can withdraw your assets from a mutual fund on any given day, in which case the price you get will be the end of day net asset value. You can sell your ETF on the secondary market during normal market hours, and what you will get is price and not net asset value. And I'll spend some time talking about ETF trading momentarily. The other, I think, element that's important to understand about ETFs is their equity-like characteristics. Because they trade on an exchange all day like stocks, investors can actually sell ETF shares short. And you see a growing instance of this across a huge number of ETFs where in some cases their short interest can be a significant portion of all of the shares that are out there that are available to investors. ETFs also, in many cases, have options chains associated with them. So investors who are looking to generate additional income on their long positions in individual ETFs might regularly sell call options, as an example. So these are features that are unique to ETFs that speak to their stock-like characteristics that differentiate them meaningfully from open-ended mutual funds. But what I would argue, again, as I alluded to before, is that as these two formats converge, what we see is that choosing between them is oftentimes really a matter of investors' own personal preferences, their own circumstances, and less so, a black and white decision, especially depending on the context in question. So there are some very tax-efficient open-ended mutual funds out there. So in a taxable setting, the difference between an ETF and a mutual fund might boil down to an investor's level of comfort trading ETFs, as an example. So I want to finish my long-winded definition of ETFs by touching on briefly what ETFs are not. As I mentioned at the onset, there persists to this day quite a bit of misinformation about ETFs and their potentially negative or disruptive impact on markets more generally. So ETFs are not weapons of mass destruction, as some professional asset managers have argued. What you will notice oftentimes is that the correlation of these headlines with the degree of risk that ETFs pose to the people making these oftentimes sensational quotes is one. ETFs represent, in many cases, an existential threat to many incumbents within the asset management industry who have had very difficult time either outperforming their indexes, have charged too much, and by virtue of charging too much for their services, have had a very difficult time keeping up with their benchmarks, or have otherwise just been plagued by outflows. So, ETFs, despite the fact that they've been around for decades, have been a growing and now a very looming threat to many professional investors out there who've had a difficult time in many cases for the better part of a decade. And what I would say is that these worries about ETFs are not, in the grand scheme of history, unique to ETFs. There are many of the same concerns that we hear from professionals, from the incumbents today, were actually concerns that were raised by professionals back in the mid-1960s when mutual funds were first becoming popular with individual investors. So this is an excerpt from the first chapter of a book by John Brooks called Business Adventures. And if you haven't read it, I highly recommend it. If you don't take my recommendation, for being worth anything, it's a book I only read because it was a book that Bill Gates called out as one of his favorite business books, which Warren Buffett recommended to him. So if you don't take the Morningstar ETF guy's recommendation, maybe Buffett or Gates could convince you to pick this one up. But in the first chapter of Brooks's book, he talks about the go-go era, the 1960s, and the growing number of retail investors in this case that were increasingly investing their assets not in individual securities, but professionally managed mutual funds. And this gave rise to talk of the quote unquote mutual fund situation among professionals, which, as the quote at the end will tell you, was so terrifying that you didn't even mention the subject. Professionals in this instance were worried that mutual fund investors would be flighty, that they would behave poorly, that at the slightest sign of stress or weakness in the markets, that they would all go running for the exits en masse and drive markets down further than they would otherwise if they had been investing in either individual securities or just simply not participating in the markets to begin with. Now, the SEC's ex post analysis on the crash that actually ensued showed that it was not newly minted mutual fund investors, the retail crowd, that drove disruption in the markets, but it was the professionals that were the ones that subsequently ran for the exits. So, history doesn't repeat, but it often rhymes. In all of the sort of fear mongering around ETFs, what we see is that what we see in today's headlines rhymes quite well with what we saw when mutual funds were first ascendant as the new technology of the day, allowing broader access to the markets, to individual investors and intermediaries alike. So having spent the first part of our discussion today talking about ETFs, defining ETFs, I want to move on to the why of ETFs. Why might they have a place within your investment portfolio? And I would argue that this really boils down to some very simple, very clear benefits. The first of which is their relatively low costs, their tax efficiency, which I described earlier, a term I borrowed from the late Jack Bogle, which is relative predictability, and then finally access and flexibility. And I'll go through each of these here in turn. So first and foremost, cost matters. What we know is that there is no more reliable predictor of future fund performance, of your outcomes as a fund investor, than fees. Lower fee funds tend to perform better than higher fee funds. It's as simple as that. And that simple arithmetic is really just undeniable. And what we see here is that the expense ratios across ETFs tend to be significantly lower relative to not just index mutual funds, but also, and more prominently, against actively managed open-ended funds. What we also know is that picking good managers is difficult. What I'm showing here is the first exhibit, sort of the signature exhibit, from a semi-annual report that my team publishes called the Morningstar Active Passive Barometer. And what this report does is it compares the performance of actively managed funds in a given Morningstar category to the performance of a composite of their indexed peers. So the group of indexed peers is the benchmark by which we define success in the context of this report. So what you see here is the success rates of actively managed funds across a number of Morningstar categories going back as far as 20 years. So, for example, if you are to look at the US large blend category at the very top, what you see is that during the 20-year period that ended in December of last year, just 12.8% of actively managed funds within that category managed to both survive and outperform the composite of their indexed peers. So you had very unfavorable odds, if you were to go back in time 20 years ago, of picking from the menu of actively managed funds in the US large blend category, one that was going to both live and outperform over the course of the next 2 decades. Now, all is not lost. What we can see, if you look at the 2 far right-hand columns, is that there are things that you can do to improve your odds of finding a winning manager. First and foremost among those is to focus on lower cost funds. So the second column from the far right shows the success rates over the 10-year look-back period among the lowest cost 20% of all active funds within those Morningstar categories. And what we see, as indicated by that green shading, is that in nearly all of those categories, just focusing on the cheapest funds in the category, the cheapest active funds, significantly improved your odds of finding a winner. Now, they still might be quite low, but they're better than a random draw. And conversely, what we see is that picking from the most expensive funds in the far right-hand column actually reduced your odds of finding a winner. Again, the arithmetic is inevitable. The math of active management, the tyranny of compounding fees is really the culprit here. So focusing on fees, you can help investors to improve their odds of partnering with a winning manager and also picking your spots. So what we see is that not everywhere is been as difficult for active managers as has been the US stock market. So notably, if you were to go into overseas equity markets, such as the diversified emerging markets category, if you were to look at the cheapest funds within that category 10 years ago, your odds were better than a coin flip. So 58.3% of the cheapest funds in the diversified emerging markets category both lived and outperformed their average passive peer over the ensuing decade. So again, costs matter, and pick your spots. Now, as I mentioned before, the cash in, cash out proposition of open-ended mutual funds versus the securities in, securities out proposition of ETFs has meaningful implications with respect to the tax efficiency of open-ended funds versus ETFs. And we went into great detail in this in an analysis we published in 2019, showing the difference in capital gains distributions here as measured as a percentage of funds' net asset values between actively managed open-end funds and passive ETFs and a number of other combinations. And what you see here is, especially in the case of US stock funds, that is a very significant hurdle for open-ended funds to clear. So even if the managers were indeed producing better performance relative to an index tracking ETF, if you were investing in that manager's fund in a taxable account, odds are pretty good that much of that outperformance would have been not accruing to you as the investor, but accruing to Uncle Sam when those capital gains distributions were being spat out of the fund. And much of this boils down to relative predictability. And when I say relative predictability, again, that's a term I'm borrowing from the late Jack Bogle, and has more to do, I think, with indexing really than it does necessarily with ETFs. So index investors have very clear expectations. They're going to get the performance of whatever that underlying benchmark might be, less a reasonable fee, or if there is even a fee. There's any number of open-ended index mutual funds as well as ETFs now that charge nothing. So this ensures that investors get their fair share of the market return. And what we've seen, if we look back at our investor return data, is that relative predictability lends itself to better behavior. So when investors' expectations with respect to performance are crystal clear from the get-go, they're more likely to stick with that fund through thick and through thin, which can be challenging to do with actively managed strategies, especially many successful ones, which can go through prolonged periods where they might underperform the market and not by any small margin. And we've seen that even amongst some of the managers that we rate very highly at Morningstar in recent years. It's been a very rough patch for many of them. The one benefit that is often touted about ETFs is their liquidity. So their ability to trade all day, every day, like a stock on the exchange. I would argue that ETF liquidity is an overrated feature. I would argue that because in part, I think it's misframed, that it doesn't tell the whole story. Because ETFs are traded on an exchange, as I mentioned before, liquidity is I think, really better framed as access. ETFs are widely available. So anybody who can trade on an exchange can access ETF shares, can invest in ETF shares in an amount as low as a single share, the price of a single share. And what you see is that many ETF providers recently have been splitting ETF shares to bring down their share prices to make them more widely accessible to a larger number of smaller investors. And there are even applications now today where small investors can invest in a diversified portfolio of fractions of ETF shares with a handful of dollars. So I think of Acorns as an example, one that I personally use, where each and every week I'm putting very small dollar amounts in an automated way into a diversified portfolio of 5 ETFs that give me access to virtually the entire global market at a cost that is next to nothing. ETF liquidity, I would argue again, is also overrated because ETFs' equity-like characteristics make them more flexible than open-ended mutual funds. Investors can go long, they can sell them short, they can trade options around them. They can actually, in some cases, lend them out to people who want to sell them short and collect a fee for doing so. So lending revenue for doing so. And I think it's important also to understand that ETF liquidity is somewhat overrated because it can create potentially the desire to trade them and do harm to your long-term wealth. Jack Bogle, is famous for saying that ETFs, are a lot like the renowned Purdy shotgun. A quote that I don't know who to attribute it to, but my colleague Christine Benz shared it with me, which is stuck with me. Is your portfolio is like a bar of soap. The more you handle it, the less you have. So there is that potential, because ETFs can be traded all day like a stock, that investors could ultimately be doing themselves a disservice by being too active, trading your portfolio too frequently. But if you must trade, there are some very simple best practices that I would recommend. What I've seen over the years is that if investors have bad experiences with ETFs, it's almost always owing to a failure to recognize and respect what the ET and ETF stands for, which is, of course, exchange traded. So if you're not careful, if you don't adhere to basic best practices, there is a chance that you could have a trade that is executed at a price that is very unfavorable. It's not what you're looking for, that you pay too much, that you don't receive a fair price when it comes to selling. The good news is that you can easily avoid a bad experience by, if nothing else, using limit orders. I would argue that use limit orders as the wash your hands, stay 6 feet apart, wear a mask of ETF trading. It's very simple advice. It's very effective. You name your price and you will get your price. Now you're obviously making a trade-off. You're potentially prolonging the amount of time that it will take for you to get a fill of your trade, but it will ensure that you do not get an unfavorable price, a price that is not one of your naming. I think it's also important to look before you leap. So to look at ETFs, premiums, and discounts, to look at the bid-ask spread, and I think very importantly, to try to, if at all possible, avoid trading during periods of extreme volatility, like we saw just over a year ago in the market. It's also important to avoid trading ETFs near the open or near the close of the market. Trading tends to be thinner around those times. It also is a point in time during the market where a lot of the underlying securities that might be part of that ETF's portfolio that ultimately inform how market makers price those ETF shares, they might not be trading themselves. ETFs, in some cases, might hold thousands of individual securities. So it takes a little while for those securities to wake up in the morning, to start changing hands, to start providing price information. So waiting a little while, waiting 30 minutes or so after the market opens, will ensure that you might get a better price than you would if you try to trade right out of the gate. And I think one of the most important pieces of advice too is that if you don't place any value on intraday liquidity and would prefer not to have to remind yourself to use limit orders or navigate any of this complexity, there are plenty of index mutual funds that provide exposure to the same underlying index. In the case of many Vanguard funds, the ETF is oftentimes just the share class of the same mutual fund. Consider an index mutual fund instead, especially if you're going to be making either regular contributions or regular systematic withdrawals from that fund over time. So I want to finish here by calling out a few of our favorite ETFs. So Morningstar began assigning Morningstar Analyst ratings. So that's our forward-looking qualitative ratings that we assign to managed investment products back in 2015. Since then, we've rated over 400 ETFs now worldwide. And what I'm going to share with you today is a few of our favorites that fall into different categories. That first category is just basic building blocks. These three funds here could be used as the basis for a very basic, very elegant, very broad, very inexpensive, incredibly tax efficient portfolio. So the Vanguard Total Stock Market ETF, VTI, Vanguard Total International Stock ETF, VXUS, and last, the Vanguard Total Bond Market ETF, BND. Now, all three of these ETFs receive a Morningstar Analyst rating of gold. That's our highest conviction rating that indicates that we expect these funds over a long period of time to outperform the vast majority of their peers within their Morningstar category on a risk-adjusted basis. And that is in no small part because these three funds charge next to nothing for the privilege of owning a very broadly diversified portfolio. So just 3 basis points in the case of VTI, 8 basis points in the case of VXUS. We had to go to another decimal place to give you the entirety of BND's fee, which is now 0.035%. And what you'll see is that oftentimes, while economically, for example, in the case of VTI, you're paying 3 basis points, what you see is that in reality, the portfolio managers, that team that manages the Vanguard fund that's situated in Malvern, Pennsylvania, is actually able to recoup most or all of that fee through a combination of savvy portfolio management techniques and securities lending. So oftentimes what you see is that that index portfolio tracks its index on a gross of fee basis exactly. So it's almost as if in many cases that fee doesn't even exist, which is really a compelling proposition, and it speaks to the level of skill involved. And you might not think that it would be the case, but there is a tremendous amount of skill involved in managing these funds, despite the fact that they're looking to just match the market and not necessarily to beat it. So the next group of ETFs that fall on the short list of our favorites is a trio of dividend ETFs. So Schwab US Dividend Equity ETF, SCHD, the Vanguard Dividend Appreciation ETF, VIG, and then the Vanguard High Dividend Yield ETF, VYM. Now, dividend ETFs are an interesting category, largely because I would argue they're much more diverse. They're much different than you might expect. So there are any number of different ETFs out there that have dividend in their name or otherwise seeking to generate equity income, but not all of them are created equal. You can see that if you were just to look at a scatter plot of their returns and their risk. They're all over the map. So why we like these three funds in particular is because they strike a good balance between trying to reach for yield while also focusing simultaneously on quality. So in the case of SCHD, the Schwab ETF, what you see is that there are very stringent criteria for stocks to be included in that underlying index, that there's a balance in that within that list that makes the cut, there's an emphasis placed on the higher yielding stocks within that portfolio. And again, not to sound like a broken record, at 6 basis points, the fee is incredibly competitive. The same applies for the Vanguard Dividend Appreciation ETF, which requires stocks to have 10 consecutive years of dividend growth to be included in that portfolio. That's a very high bar with respect to the quality of the franchises that are represented in that fund. And again, a 6 basis point fee presents a very low bar for that strategy. The last fund, the gold-rated fund VYM, the Vanguard High Dividend Yield ETF, is elegant in that it balances kind of quality and yield. So it looks at effectively the entirety of the US market and zeroes in on the highest yielding half of all US stocks, and then weights them by their market capitalization. So while reaching for yield and focusing on higher yielding stocks can oftentimes result in quite a bit of risk, what you see is that by looking for the highest yielding half, so not a narrower segment of the market, and weighting by market capitalization, so giving greater emphasis to larger, more established names, has resulted in a very nice balance between above average income while preserving a degree of quality. And that degree of quality is especially helpful, as we saw last year, when it comes to protecting investors from some of the market's downside. And another fund that has a very compelling fee at 6 basis points, charging effectively next to nothing, especially if you're to frame that in the entirety of the category. So the last 3 ETFs that I'll highlight here go a bit further afield. So the PIMCO Enhanced Short Maturity Active ETF, MINT is the ticker there, gets a Morningstar Analyst rating of gold. This, as the name would imply, is an actively managed ETF. So Jerome Schneider and his team at PIMCO are a team that we've known for a very long time, team that we've admired for a very long time, and a team that has made a lot of money for a lot of investors. And what investors oftentimes have been looking for in recent years is alternatives to traditional money market funds. And what we see is that there's been a growing crop of actively managed ETFs that look to fit this need. MINT is included among those, and one of the better ones, we think, within that group. The next ETF, iShares Edge MSCI Minimum Volatility Emerging Markets ETF. And if that name isn't evidence enough for you, this is why ETF people like me use tickers instead of full names, because I need to take a moment to take a breath after reading that fund's name. This is an interesting ETF in that it allows investors to get exposure to emerging markets stocks, which have historically, and by all accounts will likely continue to be, a more volatile segment of the global market, but do so in a way that tamps down the volatility. So this fund specifically looks to have volatility that is somewhere between 20 and 30% less than its parent index, the MSCI Emerging Markets Index. So what you see in terms of the exposure is that this moves the portfolio away from some commodity producers, from some state-owned enterprises, results in an emerging markets portfolio that leans more towards more stable, higher quality franchises. Again, a very compelling expense ratio in this case, certainly relative to active funds in the category, and a fund that earns a Morningstar Analyst rating of silver. Now, the final fund is an interesting fund for those investors that at the moment might be looking to capitalize on the rebound that we've seen among smaller stocks and cheaper stocks, and small cheap stocks in particular, in small cap value. Value has had a bit of a resurgence after what was a very long winter for the factor in recent months. And one of our favorites in that space is the Vanguard Small Cap Value ETF, VBR. So that fund gets a Morningstar Analyst rating of gold. Again, in no small part because it charges a very low expense ratio. It casts a very wide net. So the portfolio that it spins, as manifest by the CRISP benchmark that it tracks, captures a significant portion of the opportunity set available to its active peers in that category. It's made it very tough to beat, not just because it's broadly diversified, but also because it charges a much lower fee relative to many of its peers. So one we like within small cap value. So with that, I've come to the end of my presentation. I'm going to hit pause, take a breath, take a sip of my coffee, and hopefully hear from all of you. I'd love to hear any questions you have, any comments. So we'll open it up at this point.
I have a quick question that's slightly off topic, but it might be useful for people to know. I heard a presentation that came out of Vanguard of what was called a perpetual portfolio. In other words, how to put a portfolio for someone in retirement that doesn't want to manage it at all. Do you have access to material like that, or would you recommend any source? Because every once in a while somebody asks me, how do I take a portfolio and set it up so that if I disappear and my spouse has to run it, it can run itself perfectly well. Any comments on that?
Yeah, it's a great question, Lynn, and one I've certainly heard, and I I would almost defer to to Buffett in this instance, who obviously is a fan of simplicity in that respect, and said, anything that's left after he's gone is going to go into some combination of an S&P 500 index tracker in U.S. Treasuries. So, as is so often the case, I think, less is more. Simplicity trumps complexity. If I had to take any issue with, Buffett's recommendation, I would opt for a total U.S. stock market index tracker as opposed to an S&P 500 index tracker. So that's as close as I can come to a quasi answer to that particular question, Lynn. But it's one certainly we've heard, though not one, at least not that I'm aware of, that we've written anything explicit on.
There's a question.
Go ahead.
Go ahead.
Go ahead, Deborah.
There's 2 questions in chat. I was wondering if they'd been addressed.
Yeah, I can't see the chat right now.
The first one is, what do you think about leveraged ETF?
Oh, leveraged ETFs. Leverage ETFs are a category of funds that, frankly, the SEC probably wished in hindsight that they had never approved. And that has a lot to do with the fact that they were widely either misused or missold by a number of investors, particularly around the time of the global financial crisis. Now that's not to say that they don't have a place in some investors' portfolios, but I think investors need to go in with eyes wide open and to understand how those products are designed, what their intended use is, and how to use them well. And the biggest point of misunderstanding and misuse and misselling historically has been the fact that these funds' leverage ratios reset on a daily basis. So if you see a 1x or a 2x or a 3x, that applies to that day. And once that day is over, that leverage ratio is reset. So in markets like we've been in, which have been marked by kind of no alarms, no surprises. Obviously last year was a notable exception, but steadily marching upward into the right for the better part of a decade. What you've seen is that because volatility has been low, the volatility drag from that regular resetting of leverage has meant that in some cases, over a longer period of time, some of those funds have come close to matching that leverage factor that's printed on the label. Now that's a happy accident. That's not by design. So I think investors need to be cognizant of these risks to understand, how they can be used, how they can be misused, and whether or not there's a place for them in their portfolio. And certainly there are any number of professional investors that know these things well and are able to rebalance their positions regularly to maintain the desired leverage target. But there's also just countless investors that I've interacted with over the years that you failed to understand specifically how they work and have gotten burned in the process.
The second question was, how do you measure liquidity?
That's a great question. Yeah, so liquidity, I think in the most immediate sense is really just like what investors can see, like when they pull up an order ticket, with their brokerage. So you can see oftentimes like what is the bid and ask spread and how many shares are available at either price. So your bid price and your ask price. So that's kind of the most immediate measure of liquidity. I think what matters though most for ETFs in particular is the liquidity of the underlying, because ETFs are only going to ever be they're deriving their liquidity from that underlying. So those bid-ask spreads are going to be tighter. The prices are going to be closer to where the market is, for U.S. large caps than they might be for a bank loan ETF, for example. In some cases, what you see is that the ETF liquidity is actually another layer of liquidity over the underlying. So in the case of a lot of fixed income ETFs, for example, what you see is that many professional investors and many trading desks in particular, now prefer to transact in ETF shares than to go out and do like individual bond trades or basket bond trades on the market. So liquidity is very dynamic. I think for your average investor, when you're looking to execute, it's ultimately a factor of, how much is it going to cost me to trade in the amount that I want to trade at, which is most immediately, I think, measured in the bid-ask spreads and any impact your trade might have on the market. So it's abundant in virtually all of the ETFs that we rate. There might be less liquidity in smaller ETFs. So it's important to understand these dynamics. And again, the best way to protect yourself as an investor when you transact in ETF shares is to use limit orders. Yeah.
That's all that's currently in the chat.
Yeah, I see two more that came in. One is, what are actively managed ETFs? And I'm assuming a definition of active management.
Yeah, so actively managed ETFs are exactly what you might think they would be. So in many cases, what you see, and I'll use a recent example, is Fidelity Magellan is now available in ETF format. So Peter Lynch's former charge, that strategy, that portfolio, it's the same investment management team, it's the same portfolio managers, it's effectively the same portfolio, it's just being delivered in an ETF wrapper now alongside the traditional open-ended mutual fund wrapper. And the reason that asset managers are launching actively managed ETFs points back to many of the basic benefits of the ETF wrapper that I discussed in detail today. And I think most notably the element of tax efficiency that you get with an ETF relative to an open-ended mutual fund. So we've seen over the course of certainly the past 12 months, and I think we'll see more activity in the near future of asset managers taking many of their successful strategies, active strategies, and those teams that manage those strategies, and making them available in the ETF wrapper. And I mentioned Fidelity Magellan earlier. I mentioned T. Rowe Price, so T. Rowe Price Blue Chip Growth is now available as an ETF. Some of you might be familiar with Chris Davis in the Davis funds. They were early adopters of the ETF wrapper, offering many of their flagship strategies, both as open-ended mutual funds and now actively managed ETFs. So it's the same strategy, the same team, just delivered to investors in a format that's more readily accessible, less costly, and more tax efficient. So for investors, this is a winning proposition for sure. And I see that last question there, Lynn. I was just able to pop up in the chat just on how to best use limit orders with ETFs. Limit orders are a bit trickier to use. So the best way to use limit orders with ETFs is it's going to take a bit of extra care. It's going to take some more time, some more attention to make sure that that order ultimately gets filled and gets filled at a price, that you view to be attractive. So, when it comes to best practices, it's really, to try to be, close to where the market is. The market's generally efficient when it comes to setting prices, and then to keep close tabs on that order. Again, ideally you're putting that order in during kind of the heat of the day, if you will, when volumes are at their greatest. But it's going to take a little extra TLC than it would if you were to simply just put in a market order. And I should stress too that in the vast majority of cases, if you put in a market order, especially for widely traded ETFs, the likelihood that you'll get a price that is unfavorable is very low. But in order to ensure against getting a price that you do not like, that incremental layer of protection that's afforded to you by a limit order, I think can be helpful. And then another question just with respect to trading. So, not trading near the open or the close. I would generally say, the first and last 30 minutes of the trading day is how I would define that. Again, not to say it's strictly off limits if you were to do it. Your best practice is once again to use limit orders, but those are just periods of time, as I mentioned before. The first 30 minutes of the day, volumes tend to be thin. Many of the underlying stocks and bonds aren't actively trading hands yet, so prices might not be quite where you want them to be. As you get towards the end of the day, trading tends to thin out a bit. Bid and offer spreads tend to widen out a bit as well, because the market makers are trying to land that ETF price as close to net asset value on the official close as possible. So, best practice, again, avoid, if at all possible, that first and last 30 minutes of the trading day. And the last question that came in through chat here is a very good one. So, when would you want to buy a mutual fund instead of its ETF equivalent? I would say, first and foremost, probably going to be in context of, a tax preferred wrapper, right? So if you're investing in your, IRA, if you're investing in a 401k, that all important point of ETFs relative tax efficiency is moot. If you're investing in a tax deferred wrapper, there's also just the mechanics of it as well, and the costs that are involved. And now, even despite the fact that most ETFs trade free of any commission charges, there's still market impact and bid-ask spreads to consider. And if you're making either regular contributions or regularly withdrawing from a position, many investors that I've had the same conversation with, heard the same question from, simply prefer to stick with a mutual fund, when all else is equal, when they're investing in these funds, in a tax preferred wrapper, you're making either regular contributions or regular withdrawals, I think that gets to the heart of that question. So it's a good question.
I think the only question left is one that sort of revisited the question I asked early, and it is it truly reasonable to expect that an investor can set up a perpetual portfolio and never look at it again? Parentheses, depending on wealth level, of course.
No, I don't think it's reasonable. We all look at some point. As much as like the best advice is to not look, it's difficult to do. I think I personally try not to look when possible, and I still wind up looking at my portfolio probably once every couple of months. But yeah, I mean that's very difficult. It's difficult not to look, and then when you look, it's it's difficult not to do anything. But not looking and not doing anything are often the right answer. So
I think one of these days we're going to do a program where we have somebody talk about how for the investor, the husband or wife, whoever does the handling of the money, how they should prepare things just in case they leave this realm and their spouse is left. It's a really good question to ask and think about. But that's kind of a big topic that we can handle a separate time. But are there any more questions? Ben, I think you've done a great job. Thank you very much for presenting to us. And again, a great set of slides. One of the advantages of Zoom meetings is you can read just about everything that's on a slide and even the curves and wrinkles of charts. The only time we ever approached this is when we did our meetings in a AMC theater, and you could project about a 50 by 40 image on a screen in front of people in theater seating. So, but thank you very much for.
Thank you all. And if anybody ever has any questions by way of follow up, I'm pretty easy to find, and always really enjoy engaging with all of the various AAII groups that I've had the opportunity to get in front of over the years. This is I count it as one of the perks of what I do. So really appreciate it.